Good afternoon from the San Francisco Bay Area and also the Los Angeles area. I'm Jason Putnam Gordon. You're here with Idea to IPO. And today we are going to talk about investment deals gone sideways. We've got a great group together. We've got Gary Jenks from South Valley Angels and also Scale Upstream. We've got Jack Greenfield from Tech Coast Angels, Los Angeles. And we've got my favorite co-host, Mark Wald from Supporting Strategies. Before we begin today's discussion, let me give you a little bit of an overview. First, what we're going to do is we're going to have a fireside chat for about an hour or so. We'll talk about, what you'd expect to see in standard plain vanilla deals. And then we'll talk about when you deviate from that and things go sideways, what does that look like? After an hour, we'll take your questions. We encourage you to use the Q&A function as opposed to the chat function. If you want to talk to everyone else in the room, that's great. Use the chat function. I'm not only sort of co-moderating this with Mark, but I'm also running the tech in the background. So there's only so much I can handle at any one point in time. Another thing to note is today's event is recorded. So it's terrific. If you miss some or all of it, so long as you've signed up, you'll get the recording in about a week or so. With that in mind, everything is also going to be sort of memorialized for posterity. So please don't share any confidential information with us. We don't want that at this point. Now, before we begin, I'd like to have each of our panelists introduce themselves. I'll start with Jack Greenfield, then we'll move to Gary, and then we'll have Mark, and then I'll tell you a little bit more about myself. Jack?
Thanks, Jason. So my name is Jack Greenfield. You're welcome to look me up on LinkedIn. My LinkedIn alias is just Jack Greenfield, all one word. And what you'll see is that I spent a lot of time in mega cap tech and tech startups. I've been at Apple, Microsoft, eBay, PayPal, IBM, probably forgot a few in there, and 4 startups. And I'm now an investor full time. I work closely with Tech Coast Angels on the executive committee. I run due diligence there. And I'm on the fund committee there as well, which gives me a lot of opportunity to see deal flow and influence how we work with it. So I'm happy to sort of bring some comments and thoughts based on that experience to bear here.
All right, terrific. We're delighted to have you here, Gary.
All right, yeah, my name is Gary Jenks. I'm the founder, managing director of South Valley Angels. My background's a little different than a lot of investors. I've done innovation my whole career. That's all I've done. I got out of the Army, got hired by a large defense contractor, designed over 25 combat vehicles, worked with DARPA, setting the standard for autonomous vehicles, and got into startups really in 2010, and launched South Valley Angels in 2011. I built incubators around the world, and most recently I launched a project called Scale Upstream, which we believe will be the future of innovation, making it accessible to everyone anywhere.
Great, thanks, Gary. So hi, everyone, I'm Mark Wald. I'm an angel investor, an entrepreneur, a small business owner, a consulting CFO. I'm a member of Tech Coast Angels LA with Jack. I do some angel investments through that on the side. I'm an LP in some venture funds. I do consulting CFO work for growing startups. And I run a service business. We have about 300 companies. We run accounting and finance for those businesses. You can find me online at mwald.com, MWALD.com, and links from there to everything else I'm involved in. Thanks.
Thanks, Mark. Great to be back with you. Again, I'm Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney. I'm with Pulse in LA. We're an AmLaw 100 firm, 900 attorneys, 25 offices throughout the US. I focus on primarily venture-backed companies and VCs as they deploy their capital. I work a lot in the health tech space, in the AI space, and also clean tech and energy. So before, I guess at this point, we're kind of ready to launch into our real discussion. And before we get to deals going sideways, I think it's very important to frame out today's conversation and talk about first, what does a standard or a typical deal? Now, each deal is always unique. But there is a spectrum of standard terms and mechanics and legal structure. So with that in mind, maybe we could start just by asking the question, what is a startup, Gary? What are we talking about when we talk about startups?
Sure. So when we talk about startups, when we use the term startup, what we mean is a young company that is specifically looking to raise private funding. They're not going out after debt and banking and small business loans and these. That's a traditional business, small business. When we say startup, we specifically look for someone who's that wants to be in the community, working within private investors, angel investors, VC, and they're focused on a critical path that is get funded, explosive growth, and in most cases get acquired. If that fits all the above, then you're a startup.
So you mentioned VC. Jack, can you talk a little bit about that and what the path looks like, the VC path?
Sure. Yeah. Typically, and you want to show that slide there, Jason?
Yeah, you got it.
Yeah. What typically happens is that a company goes through multiple rounds of funding. Can everyone see that?
Yeah.
Yeah. Good.
Great.
So what will happen is early on, a company will start typically with its own funds. Often it's called family and friends. It comes out of the founder's pockets, closely held funds that they are able to pull from people that know them well and believe in them. From there on, they get into this seed stage or early stage funding, typically through angels. And angels are really looking to be at the very front end of the process here, looking to make investments at very high valuations. That is to say, to get very significant multiples. They're going to buy in when the company enterprise value is low and hopefully sell exit way down the road, as opposed to someone coming in much later, like a series B or C, which leads to the question of, well, what are those series? Well, that's typically where the VCs are buying in. VCs are going to buy in with preferred stock, and there's typically going to be a number of rounds of preferred stock investment by the VCs. Oftentimes there'll be more than one VC in the deal. Typically there's a lead and they sort of syndicate with others. And Series A comes fairly quickly, usually after angel money. And then you get into larger enterprise value with Series B and then Series C. By the time you're at Series C, you're close to thinking about some kind of an exit, like a strategic acquisition or a SPAC or maybe going IPO. And that's the life cycle that a healthy startup follows.
And usually an angel investor will get involved with a startup business at a valuation between 5 and 15 million. Obviously, there's exceptions to every rule, but then they're looking for that business to be worth 10 or more times that amount when it exits. 50 to 100 times would be fantastic. So those are the metrics that play into startup and the fundraising life cycle.
And from the legal perspective, I mean, we typically see the most common structure is a Delaware C Corp, and there are a few reasons for that, which are kind of beyond the scope of today's conversation. But we see Delaware C Corp set up, vesting in place with all the founders. I'm sure we'll talk about some of those pitfalls today. And we see all the IP making sure that it's making its way into the company, so there's a clean chain of title. And then, as Jack alluded to, we're talking about, especially in that angel round space, raising off of convertible notes or safes most commonly before moving into the VC rounds where it's a price round and there's preferred stock that's going to get sold. I guess with that in mind, Mark, should we stick on this topic, or should we start to talk about maybe some things that have gone sideways?
Yeah, let's go into things that have gone sideways. Hopefully everyone understands startups raise money multiple times, and there's different, like the closer you can follow convention, follow the pattern, the easier it is for all your participant stakeholders to support you along the way. So let's talk about how that works well and doesn't work well in these stories.
And in line with those stories, today's conversation is not rehearsed. We had a couple of rounds of some Zoom calls ahead of time, so we got to learn. Mark and I each bring our own experiences to the table, and we've seen things. But what I think the audience is particularly interested in, and we're interested in, are Gary and Jack's experiences, because just the volume of companies and the way that they analyze and view companies before they make an investment.
Jason, why don't you take off the screen share too?
Oh, thank you very much. Yeah. So Jack, at one point you mentioned, I think, a question where there was a situation where there were some founders who were not on the books of the company Could you tell us a little bit
Yeah.
about that at a high level? And then Mark and I may zoom in, on the finance side and on the legal side to kind of tease apart some of that.
Yeah, that was a really unfortunate situation. When they applied for funding, they showed a simple cap table with two members, a CEO and a COO, each holding 50% of the stock. They had no option pool, and it was assumed that they were going to create an option pool and then issue, using a convertible note, we would be able to buy in for whatever they closed their next round at. Because typically the way it works is the convertible note or the SAFE converts to preferred stock at the first VC-based round following the angel investment. So we were good with that, but then they gave us an updated cap table that had another 10% allocated to their lawyer. And then as things began to unfold, and here we are 2-3 weeks down the road in due diligence, we discovered that two of the people listed as members of the management team were actually investment bankers. And following up with those investment bankers in one-to-one phone calls, I discovered that each of them had been promised 10% of the company's stock for closing the round that we were doing.
Wait, let's pause here for a minute, just make sure everyone's keeping up with us. So the cap table is a ledger that just shows who owns what percentage of the company, either in actual shares or options or warrants. And then the preferred versus common. We talked about this in another webinar, Jason. We can maybe in the email follow-up reference that if people want to watch the video online. But to summarize that very succinctly, professional investors expect certain protections and rights that incentivize them to make the investment, and those basically are wrapped up in preferred shares, and common shares are what the founders get and what the employees of the company get through stock options. So the difference between preferred and common is important to investors, and when startups kind of make up their own rules and do funny things, it causes investors to scratch their heads wondering why and to get a little skittish on the deal.
Yeah.
Right. Okay. So, and then you said that the investment bankers were on the cap table as well. Is that something that you've seen before?
Not initially. Well, no, we haven't seen that before, and they were not initially on the cap table. So the key point here is the cap table kept changing during the due diligence process. Mm-hmm. Right. So that by the time we actually had the full truth out on the table, there were 5 parties, not 2, involved, and a fair amount more equity allocated than had initially been stated.
Sure. And as an investor, you want to make sure your money is going to grow the business into the future. So when you see things like that on the cap table, it might indicate that there's some debt that needs to be paid off. Or actually, I might be confusing debt with equity, but where I'm going with this is that, like, the lack of trust that creates between you and the investor or you and the entrepreneur is a big deal, right?
It's a huge deal that up front they didn't tell us the truth. And frankly, this is a key, I think, piece of advice for anyone who's raising money from anyone else, whether it be an angel, a VC, or down the road if you're dealing with a private equity firm. You have to be careful, or a strategic investor, which, by the way, is like I was at Google for 7 years. We bought a lot of companies. That's called strategic investor. They actually come in, oftentimes take a chunk of the company, take a chunk of stock, and ultimately might acquire you outright, providing you with an exit. Companies like Cisco Systems were famous for buying chunks of companies as they grew and then actually acquiring the whole company when it sort of finished its product development and got to market. But the key point is transparency and honesty. If you're not completely honest, if you're hiding something, or if you're afraid of something maybe scaring the investor away, the worst thing you can do is lie about it. Because when the truth comes out, and it will come out, because the investors will turn over every rock. It's called due diligence, and it's a process of looking at all of your documents, interviewing your customers, your channel partners, your suppliers. We'll do management reference checks. We'll figure out what the truth is. And if the truth is not what you told us, it is a complete turnoff, because it says you're not honest and we don't trust you.
Yeah, Jason, maybe you want to talk about reps and warranties as it relates to even if you're successful fooling the investor and getting their check, what happens later if they discover that you were dishonest?
Well, not good things in some, right? There are several potential, levels of liability, right? So, I mean, if you are intentionally making false statements or omitting material information, that can be securities fraud, and both civil and even criminal liability can attach to that. As there's at least one case going on right now in the public press with regard to Theranos, right? So that's a hot topic right now. I'm not taking a position as to whether or not that actually occurred, but just illustrating that it does happen from time to time. Another thing is the reps and warranties are factual statements, whether they're in a safe or a convertible note or in the stock purchase agreement if you're doing a sale of preferred stock, which make representations of fact as to something about the company, whether or not it's had any claims of litigation, whether or not its IP is fully and properly assigned. If those are false, there's contract liability that can be attached to that. Additionally, it could be a basis to unwind the deal or to have to provide a right of rescission, that is, give the money back, right? Which if you've spent the money, if your company has spent the money, you don't have it to give it back. So you're kind of up the creek with the paddle. I can go on and on, but I won't. Maybe I'd like to make sure we draw Gary into the conversation. So I'm sure he's had some experiences with.
Yeah, I can add a little bit to the equity side. A little bit different environment is where Jack was talking about shuffling the cap table around in a non-transparent way. Another example that I've seen is on the other end of it, where the cap table's fine, everything looks good, everybody's got their pieces. So we were working with a startup that was the case. Everything was fine, everything was above table, everybody had their shares. And now in the cases of a lot of the folks, not everybody had 100% of the shares yet because there was a vesting involved for some of the folks on the table. And then the company went out and got their first real contract. It was about $2.5 million. So all of a sudden, hey, we got our first big win. The company's looking good. And they decided at that point to get rid of a lot of the people that were actually on the cap table that were either senior level employees within the company, executive levels, and then decided that the amount of shares they were going to get out the door was different than the amount of shares that was allocated and established and what everybody's expectations were. So now we have a situation where everybody says, okay, they finally get their money. They let several senior level people go who've said, okay, no problem. Here's my share. Oh, no. You're really only getting 75,000 shares. Okay, that didn't set well with anybody. So that caused a lot of problems and spooled up a whole lot of issues after that. Well, the paperwork did not mean anything here. What went on here? So that was a situation we had with one startup that obviously decided they were going to not take the money and run, but take the money and reallocate it.
Yeah, sort of one observation that I've had and sort of experience that I think tracks with that is founders work very, very hard and take a lot of risk. And sometimes it can be hard to let the company go, especially if it seems like it's kind of taking off and going somewhere. But Gary, I think that really illustrates the point of just trust among the team. And also, why is that trust so important to you as an investor, right? Is you're looking, not even necessarily at the documents themselves or other things, but what are you looking at when you're sort of evaluating whether or not this founder or team is trustworthy? And I don't want to answer the question for you. Tell me a little bit about why trust is so important for you.
Yeah, I look at trust. Obviously, at the end of the day, it's all about trust because a product's a product. And when we're investing in a company, we're not necessarily even investing in, oh my gosh, this is going to be hands down the best product possible. There's a lot of best products out there. It really comes down to understanding what the opportunity is, the product fits into that, but then there's this trust of the team, because at the end of the day, the team has to execute this. The team has to make this happen. It doesn't just happen because you stand there and say, oh, I've got the best product. As we all know in history, the best product doesn't always win. So it comes down to that team. And if there's breakdown in the team and there's funny things going on within the team, whether or not that erodes on the trust, but it also just impacts the performance of the team, and it impacts the way the team operates. And now all of a sudden you have a team that's not operating at optimum capacity because they're not sure they trust it. If they go do this, well, if I go and bring in this big deal, is this guy going to can me like he did the other guy that brought in the big deal and said, oh yeah, we're done. We got the deal from you. That's all we needed. So the whole thing breaks down. The team breaks down. And what really made this deal, this particular situation more complicated, it was a husband-wife team. And so, that it went south real quick. And as we all know, nothing blows up a startup faster than a divorce in that case. So it became where the entire team became dysfunctional. And obviously in the long run, the company ended up failing just because the entire trust across the board, nobody trusted the CEO, nobody trusted what was going on. And then everybody was just doing things, holding their wallet while they were working or not really being transparent on their point of feeding information back. It was just a bad environment. And needless to say, the lawyers got involved.
Well, maybe if they had been a little bit more integrated, at the outset, they could have hopefully steered their clients in the right direction. But other times you can't. But I do have a question. So you brought up a husband-wife team. I get this question a lot, and the question is for both you, Gary, and also Jack, because I'd like to get each of your perspectives. But sometimes I do come across a husband-wife team or a boyfriend and girlfriend, or significant other team, let's call them. How does that weigh into your calculus, and how have you sort of seen that weigh into the calculus of other VCs or in angels? Some angels I've talked to won't invest in any husband-wife teams. Others are fine with it. So just interested in sort of the spectrum and kind of how you view that issue sometimes. Common question that I
go ahead, Jack. I'll let you start.
Yeah.
Okay, thanks. Yeah, well, I guess initially I'm just skeptical out of the gate of any kind of personal relationship that predates the business or is outside the business itself. Obviously, we want everyone to be friends and to get along well, and it's great for people to have social engagement. But a romantic relationship is a very different kettle of fish, especially if it's a marriage, because as was previously noted, those can end poorly with legal issues and encumbrances around them. And I've seen a case where we actually had a founder's wife who was nominally an officer of the company, but not engaged in any of the direct due diligence calls that we were doing and not providing any information, except that when we actually had Zoom calls, and this is during the pandemic, you could hear her, if you listened carefully, off camera, quietly whispering things to the founder, telling him what to say. And we began to realize that we weren't really dealing with the decision maker. It was the wife, not the husband, even though the husband was the CEO and the person presenting to us. And ultimately, this came back to bite us because we needed that CEO to acknowledge that he really wasn't properly equipped to take the company up to the next level of scale. Everyone saw that. He agreed initially that that was the case. So we brought in a member of our community to be an interim and transitional CEO, guy with great experience, 25 years, looking for a small amount of equity to sort of help the company take that next step. And the current CEO was all about stepping aside, becoming chief product officer and supporting that. But at the last minute, that changed. And it was pretty apparent that it was the wife who objected to that. And that wasn't up front. It was all kind of behind the scenes. So that really gives me, pause in dealing with anything like that.
A startup is typically a 10-year journey, plus or minus. And so you need to be the investors need to have confidence that the founding team is going to stick it out to win it all the way through to the end. And so personal relationships of any type between the founders kind of introduce new risk beyond the walls of the business itself. Also, something that Gary, you were talking about a little earlier, really, I think boils down to how we do anything is how we do everything, right? And as an investor, when you're getting to know a founder and they're sharing information with you or withholding information when they're receptive to your ideas and collaborative or pushing back, it indicates how the relationship is going to be between the investor and the founder over the next 10 years. And so as a founder, part of your job is to date the investor and show them that they want to be in business with you for the long run and vice versa.
Yeah, in fact, there's a couple areas you talked about, listening and pushing back. We had a product early years, a great product. It was an electric bicycle, a foldable electric bicycle. It was in a Toyota commercial. They had delivered several of them to Google. Everything looked really good in the early stages. And then as we moved further down to start building more and getting into the low rate production and so forth, it suddenly became aware that the CEO wasn't listening to anybody. They were a software manufacturer. They were from software side of the house, and their thought was, oh, well, we'll just fix it when we get out here into production. Well, once you start bending metal, it's not software. When that metal's bent, it's a product, it's laying there on the floor, it's paid for. And so it became, once we got to that stage, all of a sudden, the CEO just suddenly became a completely different person, didn't listen to anything. We brought experts in that knew how to build bicycles. I have Specialized 5 minutes from my house. We brought some of them in to talk to them and say, hey, here's what, because at that time, Specialized was still looking at electric bikes. They didn't have any yet. Nobody did really yet. And so we had these discussions, and in a matter of 3 months, that CEO managed to degrade virtually everything that they had done up to that point by just not listening to anything, pushing back. Oh, I know how to do this. We're going to do this. We're going to get fine. And then they tried to shortchange a few things. And eventually the bikes that they were delivering to Google, the quality was no longer there. All of a sudden, just there was a shift, just almost like black and white. When everything was a paper and they were building 1 or 2 with the local guys that were hand making them, life was good. As soon as it became build 20, the CEO changed to a completely different person, and that was another disaster.
I'd like to offer a counterpoint too. Both Gary and I describe, pathological problems, but there's some, counterexamples of management teams that are so robust and that inspire such confidence by the way they do things, the way they talk about things, the way they respond to crises, that investors will follow them through thick and thin. We've had one such company that had to pivot multiple times. If you're not familiar with the term pivot, it refers to dealing with circumstances that require you to change up your business plan in some way. Maybe a new competitor enters the market, or maybe some of the cost dynamics change. You have to make adjustments, and it's the management team quality that determines how well a company can pivot. And most companies pivot multiple times. So we have found that we can tell through the due diligence process by really getting to know that management team early on where they're going to fall on the scale of inspiring confidence versus not. And the ones that do inspire confidence end up making good on the investment, even if they have to make a lot of adjustments in their business over time.
Yeah, and I'm working as a fractional CFO with a husband and wife team. They raised an angel round and then a seed round, and they're planning for an A round, and they've pivoted, and the investors are rallying behind them because sometimes you have to pivot, like you said, defensively. Another time you might pivot because there's a bigger opportunity over here that you weren't focused on, and it requires more capital to go after that bigger opportunity, but it's better for everyone. And what better position to be in than to have investors that believe in you and your ability to execute, so they give you that capital and help attract more capital to execute on that new vision. Great points, Jack.
Yeah, I'd like to talk a little about pivoting too, because a lot of the companies we work with, there are a lot of questions we get back is companies fear the concept of pivoting because they feel if they've done that, they've erred, something went wrong, and so forth. So granted, pivots are overrated, but they're a natural process of business. Just like a plan, when we talk to early stage startups, say, you have to have a plan. Well, I don't know what's going to happen tomorrow. Well, that's okay. You have to have a plan. You plan, you execute, you adjust, and you do it for the entire life of the company. So there's certain aspects. don't hold off pivoting if it's obvious at the end of the day. It's like having that bill that you just don't want to pay it. Maybe it's a little bit outreach or at this month, but you're just going to ignore it. It's not going to go away. So the longer you ignore it and the longer you don't address a pivot, the more likelihood that it's going to go from bad to worse. So if there's a need to pivot and the team says, hey, I think we need to have something here, then you pull your tiger team together and you sit down and say, hey, what should we do at this point? And try not to ignore it. Say, well, you know, it's going to go away in a few months. It probably won't.
Gary, you mentioned to me, like, you really like to see strong discipline on finance. The early stage companies don't understand their finance. Can you talk about how that plays into the pivoting decision-making process? And
oh, sure, absolutely. So let's start from the very basics. So when we work with and talk with companies that are mainly driven and led by the technical side of the house, the CTO is really the CEO that may eventually become the CEO or CTO, but they're the CTO. When we start talking finances, they're the tend to be the most difficult one to do a financial model, because they're the same thing. Well, how do I project the future? I don't know what my sales are going to be in this. And I said, and sales are one thing, but people forget about that. The most important part, sales are nice, but we all recognize that there's all sorts of assumptions that they could be off by 50%, you know, whatever the case may be. But what's really important in the financials is cost. If you're not doing your cost and playing your cost right, then how do we know you're asking for the right amount of money? And if you're not asking for the right amount of money, I can almost guarantee you you're not asking for enough. I've never been in a deal where they were the other side around. Oh, we were way too high. We didn't need nearly this much money. If you're wrong, you're going to be wrong low, and you're going to be coming back at the end of the day. So when we look at two key documents. We look at your pitch deck as being a summary of your business model, your business case. That's your pitch deck. Your financial model is your detailed plan. If you've done it right, you've done it by month, you've planned it out for 3 to 5 years. There's nothing more detailed than that. If you tell me you're going to hire an engineer, I can go to your financial model and say, oh, you're going to hire him in November. Yes, that's our plan right now. So your financials are your detailed plan, and they're going to be in flux. As you get smarter, your detailed plan is going to change. It will likely change more than your strategic plan, which you're selling us in your pitch deck. That may not change much, you know, but when we get to your detailed plan, then that's where it's all at. And that's where we spend our time looking. At the end of the day, if the numbers work, then that brings you in the door. You're in the door. The numbers work. Now it's just a matter, do you have the team that can do that? And if you don't, let's find the team that can help you do that. And from there, the risk starts going down real quick. So one of the questions, earlier you had that chart, and I want to bring this up really well. You had the chart
I can pop it up real quick.
Yeah, you had that one with the valley of death. Okay. So you'll notice where that valley of death is. It's in the stage we're talking about right now. 99% of you on this call are probably in that valley of death. Now, one of the questions we have is, okay, everybody says 9 out of 10 companies fail in that. The polls that we've taken, only 13% of the companies say they failed because of lack of funding. 42% of the companies said they failed because of timing. And that comes into your plan and how your finances and so forth. That's where that plan comes together. It was timing, either too early, too late, wrong product, whatever the case may be. But it was 42%. It said it's because of timing. And that comes out of your planning and looking at your financial model and determining whether or not you're moving at the right pace and what's going on. So as much as people try to push back on a financial model and just kind of want to wing it a little bit and throw some numbers in there and look at my revenues, we're amazing, we're going to be a $200 million company in 5 years. The cost is really more important than those revenue statements. We can all sit down and determine whether you're going to be 20 million, 50 million, 100 million, 500 million, $1 billion. You know, it's not hard to find billion-dollar companies in the world today. You know, ink pens are close to $1 billion company in sales. So it comes down to the financial models and understanding your cost. There's no reason for your cost to be more than 25% off. You can get a quote on everything. You shouldn't be winging anything on your cost. And that's what we're looking at. Are we giving you the right amount of money? Or are you going to come back in 8 months and say, oh my gosh, we were so wrong. Now we need to get the same amount of funding again. Well, now where do we go? Now we've probably got to If we're on a convertible note, we're probably running against our cliff because the date's here real quick and nothing's close. Or if it's a safe note, we're trying to figure out, well, now this next round of funding isn't really the next round of funding we all thought was going to be, where we're all going to get money and go to the VC. And now we're just trying to fill the gap of what didn't happen. So that's really where we look at the financial pieces of it. And that's why the finances are so critical. If the numbers don't work at the beginning, then we can shake hands and say, hey, thank you, but no thanks. So that's kind of where we sit on financials. They're huge. They're just huge.
Thanks, Gary. That's exactly what I wanted to talk about. And I build financial models in my sleep. I love it. And most investors, if they aren't sharp on the numbers themselves, then they do it by committee. With Tech Coast Angels, there's a due diligence committee, and there's definitely a very sharp finance-minded person on the committee that's going to dive in. No one has a crystal ball. You're never going to get your financial forecast correct, but it needs to hold water. It needs to make logical sense, like Gary says. So it needs to demonstrate that you've thought of everything that the business is going to need to do and encounter along the way. And hopefully it also aligns with some milestones that are benchmarks for measuring success that are going to help you be successful raising your next round. So speaking of that, while we have this slide on the screen, the chart on the right-hand side, equity, dilution, and value, this really just shows the blue bars are what percent of equity the founding team or founder has in the business at each subsequent round of funding. And so this depicts 5 rounds of funding plus a series like an IPO for the exit. And so the founder starts with 100% ownership in the business. Then in a seed round, the founder brings in a certain amount of capital, gives 20% of the equity to those new investors. That's that orange slice up at the top. And then at each subsequent round of funding, every equity holder needs to give a percentage of what they have to the new investor. So you can see the founders go from 80% to 64% because they have to give 20% of their 80% stake in the company to the new investors coming in. And the original investors that had 20%, they have to give 20% of that 20%. So they have to give 4% to the new investors so that the new investors can have 20% stake in exchange for their new capital. And that pattern continues. And then the black line that you see coming up to the right shows the equity value of the business. That's the price, the valuation. So it starts at, in this chart, a $4 million valuation on the first round. And then I think that says $16 million valuation, then 20 something, and ultimately exiting at $215 million valuation. So if
the founder's equity, yeah, that's I think our numbers is based off of $1 billion.
Oh, $1 billion.
Yeah, but
thank you. So that's the founder's share.
No problem.
Yeah. So on $1 billion, if the founder raised money in the first round and their 80% was worth $4 million, then even after giving away most of the company to other investors, they end up with $215 million of equity value at exit. So it's a good deal to have a smaller slice of a larger pie.
You know, to follow on that, I have a question that we always get asked a lot in the early days, you know, is how much, you know, what equity comes out. And statistics that I've seen, I can't really read those numbers.
Yeah, and I guess, Gary, before we do that, I do want to just say, like, this is just a hypothetical composite that Mark and I have put together to illustrate.
Oh, sure.
Basically, that the founders get diluted, but the value of their stake, you know, goes up. So these numbers may or may not be correct for your company. You know, results may vary, but this is just to illustrate the sort of typical path and what it would sort of look like on a composite basis.
Well, I was actually going to go to the other end of the scale.
I just want to make sure we emphasize that.
Okay, sure, fair enough. I was going to go to the other end of the scale because one of the things we talk about, and so statistically, at the end of the day, you as the entrepreneur, at the end of the day, you start off your business, you own 100%. The numbers I've seen that say by the time your company gets acquired, most likely you're going to be between 15 and 17% of the company as the CEO when you're done, which means, as this chart says, you went from 100% down to 17, and of course 17% of $1 billion is worth more than 100% of nothing. But we get that question all the time because they're as the founders of the company, they really a lot of founders really fight giving equity away. Some are welcome to do it because they recognize the value of what that's bringing to the table. But the entrepreneur that thinks that when it's all done, the CEO that thinks I'm going to have 45% ownership of the company at the end of the day when the whole cycle's all finished, that's traditionally that's not how it's going to work out. And it's not a bad thing. That's just that math isn't likely to work. So if you're trying to fight the company and giving away equity so that you never get below 50%, then that's a battle that doesn't make sense. I just wanted to throw that out.
A good investor is going to look after your best interest as well, because we want to make sure at the early stage that you have enough skin in the game to stick with the business all the way through to exit. If you get diluted too early, too quickly, too much, then you may as well just walk away and go take a job at Google or Apple for a salary than, hang on by the skin of your teeth for 1% equity at exit.
Yeah, that's a good point, Mark. And I'd like to also piggyback on something else that you said a couple exchanges ago, which is that it's very important in each raise, or each round, as it's called, to make proper use of the funds. As illustrated on the left-hand side, the goal of each capital raise is to address specific milestones that will increase the value of the startup. And a good CEO or a good management team is able to clearly articulate what they're going to use the money for, that is what those milestones contain, and how hitting those milestones will change their valuation. And they should be able to detail that out pretty well. For example, it may be the case that a particular raise is going to fund a pilot, and that at the end of that pilot, they're going to close a deal with a prospective customer that has an LOI, a letter of intent, that's hinging on closing that pilot. When the pilot closes, the LOI is consummated into the contract, and now you have a revenue stream that you didn't have before. Your value goes up. One of the things that we've seen is that the very best management teams are able to tell us what they did with each of their previous rounds. That is to say, what milestones they were aiming to hit, what they did with the money they raised, how much money went toward those milestones, and how it changed their valuation. Really good management teams have a very tight handle on that.
Really good point, Jack. Thank you.
The other thing that Mark is able to do and helps clients with is to build those pro forma cap tables so that founders can get ahead of, in a sense, for the dilution that they will undertake in building and growing and scaling their company. And I, sort of when asked about these things, because dilution is built into the model, right? We just sort of saw that screenshot before where founder equity goes down on a percentage basis, but in terms of the value goes up. That's the model. It's neither good nor bad. You just want to build that into your plan so you understand, what's going to happen in the future based on what you know today. And if you need to pivot, you can pivot. One thing, if I may, kind of maybe shifting back a little bit to the legal side, is we talked, each of us sort of in our preparation conversations, Jack and Gary talked about, and this dovetails with the diligence, startups that don't take into account regulatory framework and structure. I think, Gary, you mentioned CARB compliance, which is a California thing we could talk about. Jack, we talked about some stuff in the medical field. Maybe I'll have a high level question first, which is, where does regulatory diligence kind of fit in from an investor's perspective? And then maybe we can zoom in on kind of nuts and bolts and why that's important.
Okay, I'll go first on that one. The kind of regulatory issues that I'm more familiar with are in the medical device space, where there's a very well prescribed pathway that companies follow to reach FDA approval, which they have to reach in order to take their product to market legally. And the steps that they follow to get that approval are pretty well understood. They involve clinical trials and various filings. And it's very important for investors to understand what that pathway looks like and where a company is on the pathway and what the time to revenue is likely to be based on historicals. How long does it typically take a company to get a CPT code approval? Well, that's a known quantity, right? So you can start to map out this regulatory process and understand the timeframes involved before the company is actually able to get product into the market.
Can I just interject real quick? CPT code, right? Billing code, so that so the company can get paid for the use of this device or whatever other service it's providing. Why that's important? That way there's a revenue stream and eventually the company can grow in value, right? Based on that value, on the revenue, and then head towards an exit. So if you're not familiar with it, that's okay. That's what it is. That's why it's important. Sorry, Jack, to interrupt. Just
No, that's fine. Listen.
Yeah.
Yeah, so regulatory. So that's an interesting area, because one of the things we ask very early on when we see a company is there regulatory things in your market space? Now, I've had the fortune in my career to have worked in so many market spaces that I have a little bit of an understanding. I've worked in everything from vehicles to med tech to cannabis to what down the road, and all these areas have varying degrees of regulations. And so we ask, is there any regulations or any critical areas of certifications you have to have in it? And sometimes the entrepreneurs just don't know. They think, no, it's pretty clear. We're just making candy bars. Well, okay, there's an entire food safety regulations that go on forever in that environment that, for things and so forth. So there's two sides of regulations. One, you need to know. Now, some areas like Jack said, like healthcare, a lot of folks, they have very specific things, but that doesn't dilute the fact that there's a lot of things to know. And so sometimes it's critical. We look at that and say, hey, you need to bring an advisor on board that understands this market space, that understands what it really is to get regulated. And you mentioned CARB, which is the California Air Research Board. One of the companies we worked with was in that space, and they knew they had to get it, but it's a $200,000 project by the time you're done getting the testing, getting everything put together, the paperwork done, and you pass that. So they kept pushing it off and pushing it off. We'll get to it. Well, until you do that, you can't sell a vehicle or anything like that in the state of California at all, period. It's just not going to happen. So the regulatory, you've got to really understand those. And if you're in a complicated, and when I was in the cannabis industry, that working with them, that was real interesting, because the cannabis industry, and they're still missing that today. They have a very thin white collar level of people in the cannabis industry. You have a lot of people that have been in the cannabis industry for 25 years, 30 years. They don't like the back of their hand, but they don't understand business and the white collar stuff you'd expect in a normal corporate world with the legal stuff, and they don't understand these kind of things. So it's critical in that case to have somebody that says, hey, we do understand that space, so that you're not making mistakes. Because when it becomes regulatory, there is no forgiveness from the government. They just, well, you're a new company. We understand. You really didn't understand how to do that correctly. So how many of you remember wine.com back in the day? Okay. They were blowing up one year, and they started blowing up right in the summer, end of summer, and then they totally blew up over Christmas time. Everybody was buying wine from them and sending it to all their families. Well, guess what? They discovered that most of the states don't allow you to ship alcohol across the borders in the mail. Oops. Well, does the government come back and say, we know you're new and you understand that, but next year we expect you to do it right? No, you're going to get a fine. And when they fine you, it's going to go back and say, you've been doing it for 8 months. That's now a $7.2 million fine. Well, that's going to bite into your $750K in funding. So that is a critical thing. Now, so I'm not to be fearful of it, but you have to understand that you have to have somebody on your team that knows what it is. And that's obviously where folks like you, Jason, can help those folks with that, or at least identify lawyers or people, advisors that know that space well. Now, on the flip side of that, to give you a positive spin on that, there is nothing better for a startup that's in a market that a regulation is coming out that's going to make your product mandatory. So
Sure.
Keep look on it up both ends, not what do I have to do? I mean, electronic medical records exploded when the federal government says, hey, by whatever that date was, you got to have electronic medical records. Well, all the startups were doing that. All of a sudden, didn't even have to do sales anymore. Everybody was calling them. Oh my God, I got to have some of these in 6 months. Well, I don't even know where to start. So there's two sides to regulatory. It can be a boom for your business. So leverage it where you can, but definitely understand what they are, and don't go faster than you, like we say, riding motorcycles, don't go faster than your headlight can see.
Yeah, that's great advice, Gary. And I'll just chime in with a couple of other areas of regulatory compliance that are currently trending and significant for SaaS-based companies in particular, which is privacy and security. Especially if you're in e-commerce, there's a number of security regulations that you have to comply with, like PCI is a standard one, an important one. And on the privacy side, there are regulations like the infamous GDPR that came out of Europe about 3 years ago, which has since been promulgated in the US in various forms and is best embodied by California's CPRA. These are regulations that require a company that keeps a record of customer data to handle that data according to certain requirements. For example, oftentimes there's a requirement that the data has to be removed if the customer closes their account. Well, do you know where all that data is? Can you ensure that if their account is closed, that you've actually found and removed all record of it? There are other stipulations such as timing out the data. When it reaches a certain age, it needs to be removed. There are also regulations around sanitizing personally identifiable information, that is removing any name, address, social security number, phone number, any kind of data element that could directly identify a person before the data is used in a particular context. And in the advertising space in particular, the sanitizing of the data is extremely important. So those are things that your CTO should know about if you're doing any kind of SaaS or cloud-based, internet-based service.
And to chime in on that, I think in my practice, I focus on the corporate and financing side of things, but we interact with our regulatory attorneys here, right? So if we've got a company that is in health tech, we have FDA specialists. If we've got folks who've got personally identifiable information, we bring in a privacy and data folks. In working with clients, a sort of general guide, investors know, early stage companies aren't going to have the same kind of compliance or may not even be subject to the same kind of regulatory burdens as a later stage company, but you should at least have the conversation with a regulatory specialist to understand what the landscape is, maybe get a sense for whether or not there are exemptions until you get to a certain size, so that you can, bake into your business plan that you would take to the investor. Okay, well, here's what we know. We're not able to quite do it yet. We need the money so that we can, that's part of the executable or the deliverable, right? To get them comfortable that they're not just signing up for a huge risk, a very risky investment, trying to minimize that, or at least put some bounds on it.
Real quick on that, we would talk regulatory here in one manner of do it, but a lot of people forget about internal regulatory, like how many employees do I have before I actually have to have an HR organization in my company? How many of this, those are the internal things nobody thinks about it. How many do I have before the union's allowed to come in and talk to my company? There's all these little things that are internal that nobody even thinks about. They think about the external regulatory like we're talking about. There's all sorts of little things that go on inside your company too that don't necessarily make sense, but they're there. And so you got to know these things.
Yeah, and so having great counsel on your side with Jason and his team, for example, where they have deep expertise in specific regulated areas and strategic areas, also obviously on the finance, HR, operations side, but then your investor family as well. Investors give you more than just capital. So part of the good ones, part of the due diligence process, I think, is really useful kind of learn on the job experience for founders, because investors are poking holes and asking questions about things that if you haven't already asked those questions yourself and answered them, then you can enhance your relationship with the investor by inviting them to help you answer the questions, and you learn from it and you're better off for it.
So we're kind of running towards the end of the hour. We're going to get to Q&A. Before we do, one thing that came up a few times was just, both Gary and Jack reference getting additional people on your team. And Gary, I think you have identified that this is a real opportunity, I think, for entrepreneurs, and a real need for them. And maybe you could talk a little bit about Scale Upstream and what you've been doing there.
Sure. Obviously, the hardest things for most startups to do, it's pretty simple. Anybody that's been in a startup understands the hardest thing to do is one, get funded, two, build a team, and three, maintain speed to market. And needless to say, the first two drive the third one. But building a team is very difficult. So during the COVID, we saw an opportunity to put together a platform, which was Scale Up Stream. Now, it just rolled out on March 1st. So for many of you that are listening, it as a platform is also an MVP new startup. The difference behind it, though, is the people that are behind it aren't new. We've been doing this for 20 years, but the platform itself is new. And one of the things we're trying to do with Scale Up Stream, and one of the things we're building is a career path for entrepreneurs. We call it fail as a startup, succeed as an entrepreneur. And so we're building a capability. So within Scale Up Stream, if you come on Scale Up Stream and put your company in there, unlike something like AngelList where you put a pitch deck in Scale Up Stream, you'll actually build a feed, a startup feed, which allows you to work, connect, and it's very robust. And within there is the ability to post jobs. Now, as a startup, that doesn't mean posting a job means you're hiring an employee. It may mean you're posting a job for a need for another entrepreneur who may come in and do that, or an advisor, or a subject matter expert, or a business professional that can now look and say, hey, these people are looking stuff. So someone like Jason say, hey, you're posting something you need to understand HR. You can apply to that, come in, sign up to that, and say, hey, we can do that for you. And it provides a dynamic, organic ability for you to find the individuals and build your team. Again, startup doesn't mean hire everybody. It's about building an ecosystem around you so that you can hire your core team, yet still have people that work with you and work with you through the ecosystem, that there's a value to doing that. So that's one of the things that we're doing on Scale Up Stream, and that in the next round, that will be fully executed. Right now, you can post, and it'll be an entire HR/career management for entrepreneurs, because there's three phases of an entrepreneur: the entrepreneur who's successful, the entrepreneurs that's stuck in no man's land, and the entrepreneur who's looking for a job. And you want to be that one in the middle of no man's land for as short as possible, because that one gets expensive fast. So anyway, it's a critical piece that's missing. Or entrepreneur is probably the only area right now that doesn't have a career
That's terrific. So I think we'll head to the Q&A. Before we do, maybe I'd like to offer each of the panelists and Mark as the co-host, maybe 30 seconds or so, just share any other thoughts you may have had that have come up during the conversation, and also either if you're looking to connect with entrepreneurs, who you'd be looking to connect with, and how to get contacted. We'll start with you, Jack.
Sure. I think probably the top of mind piece of advice I'd put out there for startups is to do a really good job of preparing the materials. Someone, I think it might have been Mark, said previously that you should think of this like a midterm exam. You really want to prepare. And the better you do in preparing your financials, your go-to-market strategy, documenting your relationships with customers, channel partners, suppliers, really detailing out what you've got, the easier it'll be, and the more confidence you'll inspire in your investors. You can think of your investors not as people who are sort of bringing money to the table in a way. You could think of them almost like an extended board. A lot of startups don't yet really have well-formed boards. That tends to happen as they move along through the funding cycle. By Series A, usually there's going to be an ask from an investor to put someone on a board, and you're going to get more of a structure there. Think of these people as business advisors who are going to help you make good decisions. And the more you can do to equip them by detailing out all that information, the better off you'll be.
Thanks, Jack. That's really good. And you want to tell people how to, if they're interested in pitching to Tech Coast Angels, the best way to do that?
Sure, yeah. There's a good bit of information there about what kinds of companies we look for, and you can sort of take a peek at that and see if you think you fit the profile. Would welcome applications if you think you do. The website, Tech Coast Angels, I think it's just techcoastangels.com. The Los Angeles chapter is the one I'm a part of, but we actually have 4 chapters that are active. Los Angeles, San Diego, Orange County, and Inland Empire. But the key is just to go to the main site. And you'll find that there's an application link that you can click there and fill in the basics about your company. And that gets the ball rolling. That application will be reviewed. And if it doesn't have red flags in it that would immediately cause it to be rejected, such as any kind of a legal issue or questionable financials, it'll make its way into what's called pre-screening. Pre-screening is where a small group of people invites you into pitch. You're familiar with the whole pitch process. If that goes well, you then get to screen. And screening is where you pitch to a whole group of angels, typically about 50 people at once. You get peppered with questions. I think Mark said it. You're just going to get, lots of questions that really help you understand where the holes are in your thesis and maybe where you need to do some more homework. But, from beginning to end, from application through to funding, I'm not sure what our absolute number is, but it's probably on the order of maybe 10% of the applicants do get funded. And along the way, if you don't get funded, you're going to learn a lot and come back around. And we welcome companies to come back around. We build long-term relationships. And when we do fund a company, we stick with them through their life cycle and oftentimes do follow-up investments. And I think maybe the last thing I'll say, and I know, Jason, it's more than 30 seconds, but I think it bears mentioning. It's on the legal front, one thing we haven't talked about is the kinds of terms that investors will put in the term sheets. This is something important for founders to understand, that as each round of investor comes on board, they will ask for specific rights. It's a much deeper subject than we have time to go into, but I think it's a very important one for founders to learn about before they get into the process and have to start dealing with those things on the fly.
Yeah, Jack, we have one question in the Q&A about that, so you can touch on your story there when we answer that question. Maybe Gary, you have your 30-second outro here.
Sure, no problem. So South Valley Angels, we're not as big as Tech Coast. We're more boutique in that aspect. We're South Valley because we're about 15 miles south of San Jose, so we're technically not in the Silicon Valley. And we're pretty straightforward. We have a once a month South Valley, it's you can send something to Gary at southvalleyangels.com. I'll get that directly. We do the classic meet once a month and so forth. Now, to change things up dramatically, scale up stream's different. Every Monday night at 7 p.m., anybody in the world can pitch to a Silicon Valley investor for no charge. It happens every Monday night, 7 p.m. First in, first gets pitched. And that starts a process. The first thing that comes out of that, when you're done with your pitch, everybody in that room is going to give you a rating on what they thought. So you're going to get a cross mixture of some investors that might be in there, average people on the street, people from all over the world that just happen to be there listening. They will tell you what they think about your ideas. We'll share that with you, and you can see really quickly what 50, 60, 80, 90 people might have thought of your idea real quick. So that's one thing. That's the easiest way to do it. But what it does is it starts a chain of events from there. Most of the time, the people that pitch won't be ready. Some are. We just had one Monday night. She was amazing. She was absolutely ready to go, and she's going to stage one on next Tuesday. So from that point in time, what we can do is we can feed you off again and help you work with the subject matter experts to get you ready, like Jack said. And then once you get that, you go to a stage one. Once you move it through there and you get to where you're going, then we can forward you on to Jack and say, hey, you got it perfect. You're just what Tech Coast Angels are looking for. Go down and talk to those guys. And so that's uniquely different. So anybody can pitch anytime, 7 p.m. San Francisco time.
Thanks, Gary. All right, I'll go next here very quickly. So my website, my sister just helped me put it up online last week. I'm very proud of it. It's mwald.com, M-W-A-L-D, as in David. That's my name, Mark Wald, mwald.com. Has links to things I'm involved in, my interests, the way I think about startups and finance. And I operate a business, like I said, we provide accounting and finance support services to pre-revenue startups all the way up through Series B and C funded companies and some nonprofits and small businesses along the way. So I'm your finance accounting guy. I love technology, innovation, efficiency, process, and problem solving.
Thanks, Mark. It's great to be co-hosting again with you. I had a lot of fun. We'll be sure to include the link to our last event when we send out this email so people can check it out. We can unpack and learn about the pro forma cap tables and why it's so important to make sure that you've built those. I'm Jason Putnam Gordon. I'm a venture capital emerging growth company attorney. I'm with Polsinelli. which is an AmLaw 100 firm, 900 attorneys, 25 offices in the US. I work with companies, their form, financing, acquisition, outside general counsel in sort of health tech, AI, and IoT and environmental companies. I also work with investors as they deploy capital. Great way to connect with me, LinkedIn. Another way to connect if you want to, set up. I keep office hours Friday afternoons. jgordon@pulsinelli.com. With that, I think it's time for questions. Mark, it sounded like you identified a question for Jack, so I'll let you start with that.
Yeah, thanks. So Chuck Nolan was asking, can employee stock options be preferred, or can employee stock be preferred without voting rights? And where the founders convince investors that maintaining control will improve odds of survival, can investors be issued preferred stock without voting rights? So Jack, maybe you want to tell us a minute about that kind of harrowing story with the different classes of shares, and then answer that question specifically.
Sure. And for the detailed answer, I'm gonna punt to Jason, but I'll say this. You want to stay in the center of the lane. You don't want to get off onto the shoulder doing unusual things. The normal approach is that common stock is what's held by the founder and employees of the company. Typically, employees are paid through stock options, which become common shares when exercised. Investors will typically take preferred stock, and it's called preferred stock because it has specific rights that go with it. An example of that would be liquidation rights, which is to say that when the stock is liquidated on a sale of the company or an acquisition, there may be some multiple to which that investor is entitled that helps provide a floor on the value of their investment. Another example of a right would be a pro rata right, which is downstream, that investor gets to invest again in later rounds in proportion with what they did previously. This is something that's actually very important to angels. As I mentioned at the beginning, angels like to invest when the company is very small and the stock price is very low, and continue building their position on the winners. That is to say, they'll invest in lots of companies. The ones that are moving ahead get repeated investment, and pro rata rights help ensure that that's possible. There's all kinds of others, drag along rights and all sorts of other things that get complicated. And I'll leave that to Jason because that's a complicated space.
Sure. I agree with everything that Jack said. Big picture, you don't want the investor spending a lot of time looking at the legal because there's a set path to do it. And so if you confuse them, you suck up their energy in terms of, having to try and figure out why the structure is the way it is. You're probably not going to end up getting the investment that you want. So, takeaways are you get sort of bespoke, unusual terms baked in the structure. It's expensive to put them in, expensive to put them out. Not the way that I want to make my money off of the clients. Not the way, because I know long term, the value of the client relationship is going to increase as you grow and scale. I'm not investing dollars, but I'm certainly investing time into client relationships, and putting in bespoke, unusual terms, not going to get you there. Sometimes founders ask about sort of voting rights and 10x voting rights and other things because they hear about famous companies that have those when they go public. That typically actually gets put in place right before the IPO. It's not put in necessarily right at the outset, unless you are a wildly successful, previously successful entrepreneur, and people are going to throw money at you no matter what you do. The well-worn path is the way to go, and you don't want to try and set up some unique sort of preferred stock equity incentive plan for the founders. It's just not going to get you where you want to go.
Yeah, talking about unique stuff again, there's another question asking if we've seen, Gary, I'll pull this out to you and Jack, I guess. Have you seen a situation where an investor, either an angel or a VC, was looking for both equity in the company as well as some ownership percentage of the IP as a safeguard in case the company itself fails, but the IP is still marketable, I guess?
Well, sure. I mean, at the end of the day, it's, one of the things you have in your back pocket is the IP. Obviously, what we've seen is situations where the company fails and the investors take over the IP and put another team around that and build it. So they're kind of a separate question. Owning equity in the company and owning IP, they kind of go a little bit together because you're owning part of the company and the IP is a document within that company. But at the end of the day, they're separate from the fact that, you know, we're investing in the company. But yeah, the IP is important, and we have seen situations where the company failed and the only thing they had was IP. And the reality is when a lot of companies go to get acquired, unless you're doing something like a WhatsApp where they're just buying your multi-million people list, when companies come and acquire you, again, keeping in mind that more than 95% of companies get acquired by a corporation, they don't go IPO. Those companies are again, if they're not buying you for having 20 million people in your platform, they're buying you for your IP. That's why they're buying you. So yeah, that's kind of a simple answer, I think, for that. It can get more complicated than that, but that's kind of a simple one, I think.
Thanks, Jack. Do you have anything to add there?
Yeah, this is more for investors than for entrepreneurs, but it's very important for the investor to understand where the IP comes from and where it sits. We actually had a case where the IP in question for a company that looked really exciting had come through several previous companies owned by the same entrepreneur. And at the end of the day, ended up sitting in a company that was not the one we were being asked to invest in. So that's a big red flag. So
yeah, you definitely want to.
Yeah.
Sorry, go ahead, Jack.
I'm just going to say the obvious. As an investor, you want to be sure you know where the IP lives.
That's right. And I think the short answer to that whole question is exactly what you said. You want to invest in the company, and the company itself should own the IP you're investing in. There's no need to also have a stake in the IP itself, because if you have an equity stake in the company, then you control the IP.
Yeah, and the only sort of scenario where I've seen, and it's a very unusual, pretty uncommon scenario, where we will see an investor get basically a security interest in the IP, especially if it's like patents or hard IP, is if the company is kind of out of cash and they're doing like some sort of bridge round, and so it's a pretty risky financing, and it's supposed to be a bridge to get to a next equity round or some recapitalization of the company. And then occasionally we will see the IP, there'll be a security interest that gets tied to the investment, but that would not be the starting place for 99 out of 100 times.
I was looking at a question out there that's very, very common that comes up all the time, and they were asking about having part of your team outside the U.S.
I was going to ask that one. Yeah, that's great. Go for it, Jake.
Yeah, I saw it when I was looking there, and that's probably one of the top 10 questions we get across the board. Now, I'll give you an example. So the very first startup I was in my younger days was in 1999, beginning of the .com. So when this question comes up, it traditionally has to do with the development team. In most cases, the software development guys aren't in the US, they're somewhere else. Now, that used to be a flag back in the .com days, because back then, if you said our development team was in India or Ukraine or pick a country, it often meant that the server was in their closet, which means that if there's a problem, good luck getting your source code. Now, today, that problem's gone away. You're on Google, you're on AWS, you're somewhere that everybody always understands. So, as a quick little tidbit of suggestion on that, when you're working with that team and they get you all set up, they say, hey, you're on AWS, we got you running, we're building your stuff, great. Take all their passwords, close them, and give them their passwords. Then you have control of it. It's always going to be on AWS, but if you've got their password, if you're having an issue with somebody over there, you can just turn off their password, and life's good, more or less. Doesn't mean they can't hack it, but in simple terms. Now, so the problem of having that overseas is not nearly as bad as it is. But what you don't want is to have a team of 8 people, 7 of them overseas, and 1 person is floating around here in the United States that is the US person. So what we generally would recommend in that is you have your business team, your CEO, your CTO, the core executive team here in the US. Having a development team, which usually fits 90% of the startups we work with in the software world, that's not a problem anymore today. But we will want to understand what that really looks like, who are the people, what's going on there. But the fact that you're no longer having servers in closets and a lot of that stuff, that risk has gone away. So it's not a game changer like it used to be. but you can't have most of your team overseas and you're one representative who happens to live here. That increases the risk. So that's just I wanted to address that a little bit. Having the bulk of the team here is good. Development teams over, that's standard operating procedure pretty much today.
Yeah, I'd add to that with your best IT practices. There's plenty of good solutions out there for two-factor authentication, single sign-on, and the more you can utilize those tools at the beginning, the easier it is for you to scale without losing control.
Yeah.
So we've got a question that is about diligence, and we touched on diligence earlier. And certainly in my practice, we sort of see as the round sizes get bigger, the diligence becomes more extensive. Just as the documents themselves become more extensive and robust, right? Moving from convertible notes to maybe NVCA light to full suite NVCA docs. It'd be great, Gary or Jack, if you could kind of maybe talk about sort of your experience or your take on kind of level of diligence, kind of as it relates to, where in the life cycle the company is and kind of what expectations what information the founders should, what the investors would ask to see from founders and what they should be prepared to, what the founders should be prepared to provide.
Sure, I'll give you early. I'll do kind of more early stage. So obviously, As an early stage, you're not going to have a profit and loss. You have no profit. You have no loss. You're all lost. You have no running actuals and expenses in many of those cases. You may be spending money, but not there. But the documents would, you could go to any documents you would need for anything in banking and so forth. A lot of investors, we're still based around the banking kind of industry. So you've got to have, obviously, your fundamentals. Everybody knows your pitch deck, your executive summary. But outside of that, you do need to have your financials, and a lot of even early stage are asking for things like profit and loss statements. Any documentation, your corporate documentation, like we talked about, are you properly, do you have your bylaws? Have you done all your proper paperwork? Are you winging it as a startup, or are you really laying the things down? The list of documents can get extensive. At the beginning, you don't have a lot just because you don't have a lot to document, which all that does is increase risk on the investor side because they're not there. As you move down the pipe and get closer, to getting, funding and more of that kind of funding, now you have actuals, you have things that feed into what you're doing. You've got documents that come along with what you've done because maybe of a certifications or like we talked about earlier. But it's there's not a whole lot in the beginning that's out there. And again, every investment group, a lot of investment groups now, they have a template. You go and fill your template and they ask for all these documents. And some of them will just say, if you don't have these documents, then you're not complete, therefore. And that becomes kind of challenging for very early stage companies where it doesn't necessarily make sense for them to have a 1-year P&L statements of what you've been doing. So it's a little grayer at the beginning, but there's those fundamental things, where you are on that. And with corporations, you don't necessarily have to become a corporation on day one. You can do things. You have to become incorporated before you start giving anybody shares and breaking down and actually operating like a business. But anyway, so that's kind of a real simple from very early stages. And Jack, I'll let you take it kind of from the early Jello stage to actually having real documents that mean something.
Thank you, Gary. Yeah, we're slightly later stage than Gary and South Valley. We tend to be interested in companies that have some traction in the marketplace. And what does that mean? Well, ideally, that means you have some revenue. That is to say, customers are paying for your product. We have invested in companies that don't yet have revenue, but those are much fewer and further between. In place of revenue, what they would have to demonstrate in order to get funding is customer demand. And typically that could come in the form of surveys or pilots of various kinds, where there's clear evidence that there is market demand for what they're offering and some sense of what the price point is likely to be so that we can estimate revenue. Another thing that's very important for us is to understand unit economics. And by that, what I mean is things like, what is your customer acquisition cost? How much do you spend in digital marketing or in whatever other expenses to get a customer into the business. And related to that, what's their lifetime value? How much does a customer typically spend over the course of their interaction with your company? The ratio between those two is very important. And another factor that comes into play is churn rate. How rapidly do your customers turn over? Do people try your product, kick the tires, and then leave? Or do you have customers that stick around and continue to pay and grow the subscription? Those are really key metrics that we look at that help us understand what kind of market traction you have. And that plays a lot into our willingness to fund.
And I like to simplify this into just real world analogies. So let's say you're dating the investor and you don't want to bring them into your apartment because it's a mess, right? Everything's held together with duct tape and bubble gum. That implies to the investor that once you take their money and you buy a house together, the house is going to be a mess. And what's going to happen when you scale the business up even larger than that? So you need to demonstrate that you can be accountable, transparent, diligent, and organized. Otherwise, you don't have what it takes to run a larger company with more capital and put more capital at risk.
I like that house. I like that. That's a good example. I like that. I may steal that from you.
Yeah, that's well said.
That's why we have him here. So I don't think that this question has been specifically asked, but it is a very common question. And some of these questions on here, I think, kind of get to it. What are the best ways to kind of identify the right angels and to prepare for meeting with them? We got two experienced entrepreneurs and angels right here. What are your thoughts?
I'll jump in. Oh, go ahead, Jack.
I was going to say, Gary, I think you should probably take that one first because Scale Upstream is really, if I'm not mistaken, squarely addressing that question.
Yeah, so there's a couple things. So finding investors are difficult. I mean, even here in the Silicon Valley. So wherever it says, I'm going to come to the Silicon Valley and get funded. Just for reference, if you were just to go to two groups, Band of Angels and Sandhill Angels, they have well over 300 angel investors, just those two groups. And there's well over 100 angel groups within 45 miles of Palo Alto. So you would say, oh, well, I can find it here. Now, if you're in Tulsa, Oklahoma, or Billings, Montana, that's a little more complicated. And that's one of the reasons that we brought Scale Upstream, which was to try to help our networks of the folks and connect with people, because that's important. At the end of the day, a cold calling is still more difficult than a warm introduction. Most groups like Tech Coast Angels, you have to be sponsored in many cases to come in there. You have to have an investor behind you who not necessarily has invested in you, but they're saying, hey, I like what you're doing. I'm willing to be your sponsor and bring you in and hand carry you in the system. So that's pretty common in groups. Now, if you're out looking, you're just going out, you're hitting Google and you're trying to find investors within 500 miles of your house that you could possibly drive to and go meet, then there's a couple things to look at. The biggest problem we see is entrepreneurs seem to instantly want to jump to a VC. And then they come back to us and say, gosh, they say I'm too early. Well, tell me about you. Well, you're too early for an angel investor, let alone a VC. So understand who you're looking for. What are you asking for, where you're at, your stage, and talk to the right people. Another thing is investor alignment. Most investors in their groups, you go out and look at their website, they'll tell you kind of what they invest in. Now, what you don't want to do is go look and see necessarily say, oh, look, they went out and invested in somebody just like me a year ago, but I'm in the next generation of that. Great, I'm going to go ahead and ask them because they've already done that, they'll do it again. Well, probably not. If they've already invested in something, they're probably not going to invest directly in a competing product. However, what you do want to do if you're going to go down that road is take a look and see if your product is complementary to something they invested in. Because if they invested in one of these and if they invested in an electric car and you're a charging station company, there may be a complementary that says, oh my gosh, if we put these charging stations in every corner and they work perfectly with our cars, now there's a complementary. Many investors get very excited about complementary because that comes 1 + 1 = 4. And between the two of you, that can be a compounding growth. So don't worry about competing. Look for complementary. That's a simple term there.
Great. I have a real quick one I can give an answer to. What are investors most comfortable with funding, i.e. use of proceeds? That goes into your financial forecast model, and really your use of proceeds should be to enable you to succeed at hitting those next milestones that attract the next round of capital, that hit those next proof points. Your use of proceeds should not be paying for old debt, paying for a backlog of salaries that you hadn't paid to your staff. It should be paid for things that you're going to do tomorrow with that money that makes you a more attractive investment for your next round.
Yeah, I'll just underscore that. The investor thinks of the money they're putting into your company in terms of the return they're going to get on it, right? Not just long term, but even in the sort of the near term. If I give you $1 million, what are you doing with that $1 million? And what return will I see in terms of the value of the company increasing because of what you did? If you take, let's say you're a $4 million pre-money, that is before any money's invested, your valuation is $4 million. Let's say I put $500,000 into your company, okay? At the end of that $500,000 spend, what is your company worth? Is it worth $4,500,000? In which case, it hasn't grown at all. And my money hasn't really increased in any way. If, on the other hand, at the end of that $500,000 spend, your company is worth $6 million and you're going out for another round at 6, then my 500 has multiplied. And as an investor, I'm looking for what you're going to be able to do with the value of your company, given the investment.
And how it would go from 4.5, go from 4.5, have that 500 spent down to becoming now 6 is, maybe you're able to get some customers, right? You're able to get some additional streams of revenue, other indicia that the company is now more than just that $500,000 that was put in. So with that in mind, we've now rounded to about 1:30. I'll give each panelist maybe 15 seconds to say anything or their contact information if they don't have anything else to add. And then we'll sign off because I believe in start on time, end on time. Mark?
Sure. Thanks, Jason. Always a pleasure doing these with you. Looking forward to more. And I'll just end with, give me a call if you need some help with your numbers.
Gary?
Sure. Thanks again, Jason. I would just say it's a process. You're not going to close the deal on your first pitch. So just ignore that right now. It's a process, and stay engaged. You can't sit back in a vacuum and just shoot out emails to people and think the world's going to happen. Stay engaged and don't focus everything on that one meeting. It's a series of meetings that will get you there.
Thank you, Gary. Jack?
Yeah, I'd like to plug Scale Upstream. Investors like us like to see companies that are a little further along and that have taken advantage of the kinds of services that are available from Mark, from Jason, and that Gary and Scale Upstream can help bring to the company. So please take advantage of those things and come to us when you have something that you think is going to be investable by an organization like ours.
Well, thank you very much, Jack.
Terrific. This has been a fantastic panel. I want to thank you, Mark Wald, Supporting Strategies, Gary Jinks, South Valley Angels, and Scale Upstream, and Jack Greenfield at Tech Coast Angels LA. I want to thank each of the attendees today. Thank you for attending. I want to thank Idea to IPO for putting together and organizing today's event. Again, so long as you've registered, we will send you the video within a week or so. Other than that, I hope everyone has a wonderful afternoon, and we'll let you get back to building your great companies. Take care. Bye-bye.
Thank you.